Alright everyone, welcome. This is part 2 of chapter 2, and in part 1 we learned how to apply our manufacturing overhead costs to jobs in a job order cost process system. Now, real important is that we learn how those costs are first accumulated before we apply those costs to our work in process inventory. So I want to go through some actual business transactions where we are moving the amounts through our inventory accounts, and specifically how we move the amounts through the manufacturing overhead to the work in process account. So let's take a look. So first of all, one of the first things a company might do is, of course, purchase raw materials, right? And when they do that, we know, of course, the journal entry looks like this. Our raw materials inventory gets a debit to increase it, and we would either be paying with cash, that would get a credit, or if we just owe our supplier, we would have a credit to accounts payable. What I want to show you, of course, in the general ledger accounts is just the inventory accounts. So with the purchase of raw materials, we would be debiting or increasing the raw materials account. All that's happened there so far. Next, of course, when we start using those materials in our production, we would, of course, be reducing the raw materials account. That same inventory account is now getting reduced because we're taking it out of raw materials and putting it into production. When we're putting it into production, the actual units that can be easily traced to units of production would be, of course, the direct materials. But there is no account direct materials. Remember that. It goes right into work in process. The direct materials amount goes right into work in process. The other materials that we're using in the manufacturing facility and to help us create it, but we can't trace those materials specifically to units of production. Good examples are grease or parts for the machines that we're using in our plant, or anything else that's used in our plant that we can't directly trace to the units of production, goes into overhead. So we'd be reducing the raw materials amount, right? And we take one amount into work in process, that's direct materials, and we take the rest of the materials that we're going to be using in the manufacturing facility into indirect materials. So we're increasing this manufacturing overhead account, and we're increasing work in process by using up some of those materials. Now, the next part of manufacturing cost is, of course, labor costs, right? And specifically, direct labor costs. So as we start paying out salaries and wages, of course, we would credit our wages or salaries payable, or if we're paying them in cash, we'd be crediting cash. And the people that are direct laborers, we would, of course, be their salaries or their wage amount, we would, of course, be debiting directly to work in process, right? We're capturing those direct labor costs right into work in process if we can trace those amounts directly to individual units of production. The other salaries, like managers or supervisors at the manufacturing plant, even security guards and other workers at the manufacturing plant that are not direct laborers, we can't trace their salaries directly to individual units of production. Well, they, of course, go into manufacturing overhead. This is how it looks there. So once again, we are increasing the costs in work in process for the direct labor that we can easily trace there. And of course, the labor cost that we cannot directly trace to units of production goes right into manufacturing overhead. Notice that all we're doing is accumulating a lot of costs in manufacturing overhead, and they will eventually be applied to the work in process account in just a bit. Not yet. Right now, we'll just accumulate them there. So on top of the indirect materials and the indirect labor to manufacturing overhead, as I've discussed numerous times, and the book does a very good job of explaining this as well, there's tons of costs associated with production or manufacturing that cannot easily be traced to units of production. All of those, and just a couple examples laid out here, would all be accumulated once again in manufacturing overhead. We've got the property taxes, and this would have to be specific to the factory or to the manufacturing plant, not to the sales offices and not to administrative offices, but specifically to manufacturing. Same thing, insurance that's specific to manufacturing depreciation that is specific to manufacturing. Remember, if it was not specific to manufacturing, it would just be expense. Property taxes would just be an expense for the period. Since they are specific to manufacturing, however, we need to capture them as part of the cost of those units of production. So they go right into manufacturing overhead. So now we've accumulated a bunch of costs, everything that is manufacturing related that we cannot easily or directly trace to units of production. Now the way we apply it, of course, we will talk about in just a bit, but once we apply that manufacturing overhead, we've got to move it into the work in process account. This is what the journal entry would look like here. So we take all those costs out of manufacturing overhead and move them into work in process. Now, we're going to be doing this using a predetermined overhead rate, and we saw an example of that previously, right? So unfortunately, since we're using a predetermined overhead rate to apply these actual costs that we have incurred during the period, usually these amounts are not going to be exactly the same, and we need to have them be exactly the same, or we need to make a year-end adjusting entry in order to fully use up all of these manufacturing overhead costs, which we'll talk about in just a bit. That'll be the last section of today's lecture. For now, let's keep tracing those goods. So once we've gotten the manufacturing overhead and the direct labor and the direct materials into work in process, once we start finishing some of the units of production and they're ready for sale, we would of course reduce the work in process and increase finished goods inventory. And then, of course, finally, when we make some sales of those finished goods, we all know these journal entries quite well. We would, of course, be debiting our accounts receivable or cash if we're receiving cash for it, crediting our sales to show the revenue that we have earned once we sell those goods, and, of course, we'll be reducing the finished goods inventory and recognizing the expense that goes with that, the cost of goods sold, right? And matching thereby the expense with the revenue that it helped generate. And so this is how it finally flows through. After we sell the finished goods, it comes into the cost of goods sold, that major expense for any manufacturing facility. Now, the problem, of course, is since we're using an estimate of manufacturing overhead rate, and that's what we're applying, we need to make sure that we have properly applied it. Because we're using an estimate, we will never have perfectly estimated it, and there will be either an over application or an under application of manufacturing overhead costs. So the difference between the overhead costs that we applied to work in process using that predetermined overhead rate versus the actual overhead costs that we incurred during the period will either leave us with under applied or over applied. Now, under applied overhead exists when the amount of overhead applied to the jobs during the period using that predetermined overhead rate was less than the total amount of actual overhead costs that we incurred. And over applied is the exact opposite. Let's go ahead and jump right into an example here. Same company, let's assume, and same example, let's assume that Pear Company's actual overhead for the year was $650,000 with a total of 170,000 direct labor hours worked on jobs. Remember that we estimated 640,000 and we thought we'd have 160,000 direct labor hours. That's how we came up with that predetermined overhead rate of $4, right? So we now had more of actual overhead costs. This is what we came up with before. Now, what we applied during the period is shown below here. We had a predetermined overhead rate of $4 and we had 170,000 direct labor hours. So if you multiply that out, this is what we actually applied, $680,000 that we moved from the manufacturing overhead account into the work in process account. The problem is we only had $650,000 of actual overhead costs, yet we assigned $680,000 cost to it. So we applied more than what we actually had, which means we are over applied by $30,000. So how do we fix it is the next question, right? We now assign too much cost to our inventory, meaning our inventory costs us $30,000 less than what we actually assigned to it. The problem, of course, is we've sold some of that inventory is still in work in process, and some of that inventory is just sitting in finished goods inventory. So how do we fix it? We don't know where that inventory is, and how would we even track that if we knew how? Well, luckily, we don't have to worry about that. There's a very simple method of correcting that, and the journal entry looks like this. What we do is, if we had over-applied, we would, of course, have a $30,000 credit in our manufacturing overhead account. If we under-applied, we would, of course, have a debit amount. And the important thing is, at the end of the period, we want manufacturing overhead to have a zero balance, right? Manufacturing overhead, best way to think about it is it's a temporary holding account, where we put in all the costs, we accumulate the costs, but then we want to move them right out into work in process once we have a rate to do so. But if we were perfect, of course, we would have moved only the $650,000 and applied only the actual cost. But since we use that predetermined overhead rate, there's always going to be a difference. Sometimes it'll be over-applied, sometimes it'll be an under-applied amount of manufacturing overhead. But to fix the situation, we just need to get manufacturing overhead to a zero balance. So, in this example, we would of course be debiting manufacturing overhead by $30,000, and the other side of that is, of course, we move it right into the cost of goods sold, no matter what. Whether we're debiting or we're crediting manufacturing overhead, we will be doing the exact opposite to cost of goods sold. Is this perfect? No, it's not perfect, but it makes a very simple and easy way to solve the problem of using a predetermined overhead rate and making sure that we don't under-apply or over-apply overhead at the end of the period. So we would just adjust the balance of cost of goods sold. That's it for Chapter 2. Hope you guys enjoy. See you in Chapter 3.